A very good morning to all the participants of this webinar from DTRTI Lucknow. I am Arvind Mishra, welcoming you to this webinar session on 27th of October 2020. And in this webinar session, we'll be dealing with ledgers as part of our bookkeeping and accounting series. The chapter name that we are doing now is Principles in Basic Accounting Procedures, and we are doing Unit 2, which is called Ledgers. After studying this unit, you will be able to understand the ledger concept. You will also learn how ledger posting is done, what is the technique of the ledger posting, and how the accounts are balanced. Then you will also learn how accounts are opened every year by taking the closing balances of the accounts of the previous year. Also, we will study the use of the terms balance carried down and balance brought down. Friends, ledger is known as the principal book of account as opposed to subsidiary books. Ledger is the principal book of account. The spelling of principal here should be P-A-L rather. And as an overview of what we are going to study, we can point out that in this unit that we are going to study, we'll study the process of transferring the journal entries into the ledger accounts. Number one, because the first thing that we do is making entries into the journal. After that, those journal entries are transferred to the ledger accounts in the ledger. In this unit, we'll also study how do we take the difference between all the debits and all the credits of any account, and thereby we take the balance of that account. We'll also study how the remaining balances of every account are carried forward to the next year. We will also study some of the balances of some accounts in the ledger are transferred to the profit and loss account. Because the ledger is then used to prepare the trial balance, the ledger is also used to prepare the profit loss account and trading account, and of course the balance sheet. So ledger is the principal book of account. Now, after recording the transaction in the journal, once we have recorded the transaction in the journal, we have already recorded the entries in the journal, and now we are classifying those entries and grouping those entries So the work of classifying the entries and the work of grouping the entries is part of ledgerization. So that book of account, which contains all the types of accounts or all sets of accounts, whether they be personal accounts or non-personal accounts. As you know that there are two types of non-personal accounts, real and nominal. So all types of accounts, all sets of accounts, personal, real and nominal, they will find a place in the ledger. So ledger is a collection of all the accounts. It is known as the principal books of account, and in this ledger every account-wise balance of each account is determined. So the balance of every account is taken, calculated in the ledger itself. Now the ledger account has all the accounts in the ledger have two sides. One is the debit side, debit means left side, and other is the credit side. So credit side is the right side of the account. Now debit side has four columns: date, particulars, journal, folio, and amount. Similarly, the credit side also has four columns: the date of the transaction, the particulars of the transaction, the journal, folio from where this entry is coming into the ledger account, and the amount associated with that transaction. So these are the four columns on both the sides, debit as well as credit side of the ledger account. Please remember that when we say debit, we mean the left side, and when we say credit, what we mean is the right side. Now the word posting you must have heard. So when we say posting, it means we are posting into the ledger from the journal. So the process of posting is the process of transferring the debit entries and the credit entries from the journal to the ledger, and in the ledger all the accounts are classified and grouped properly. So the process of transferring the debit and the credit items from the journal to the classified accounts in the ledger, this process is known by the word posting. When we say that the posting has been done, it means that the journal entries have been posted into the ledger. Now, what are the rules regarding posting of the entries in the ledger? Number one rule is that for every account, a separate account is opened in the ledger book, and all the entries in the ledger account are posted to the respective account in the ledger. The entries are taken from the journal and they are posted to the specific account in the ledger or the respective account in the ledger. Because for every entry there is a respective account in the ledger, and accordingly every entry from the journal is posted to the ledger. Now, while posting an entry into the ledger, the second rule is that it is a practice to use the words to and by while posting any transaction or entry in the ledger. So the word to is used in the particular column with the accounts written on the debit side. So whenever we make an entry on the debit side of any account, we start with the word to, and when we make the entry on the credit side, we start with the word by. So on the left side we start with to, on the right side we start with by. These words to and by do not have any meanings as such, but they are just in usage, that whenever we debit any account, we start with to, and whenever we credit any account, we start with by. And when we say that we debit any account, it means that we are making an entry on the left side of that account. Whenever we say that we are crediting any account, what we are saying is that we are making an entry on the right side of that account. So wherever there is a debit entry for any account in the journal, that account would be debited in the ledger. But though we make the entry on the debit side of the ledger, but while making the reference or while writing the entry, we make the reference of the respective credit account. This is an important point that we are writing on the left side of the journal, or sorry, left side of the ledger account, while posting a debit entry of the journal into the ledger. First thing what we do is we identify the concerned or respective account where we have to make the entry. After having identified the account, if you have to make the entry on the debit side, because that account is going to be debited. Now, how that account is identified? Is account identified by the name itself in the journal. For example, if it is written bank account debit 5,000, that means bank account is the account in the ledger on the debit side of which we will make an entry. So when we are making the entry on the debit side, we say that we are debiting that account. But while making the entry, the words will carry the information about the credit account. Though we are making the entry on the debit side, we are making the reference to the credit of the account, or we are making a reference to which account is being credited. So we'll just understand these three principles, or the three rules regarding posting of the entries in the ledger. But before making the entry in the ledger, the first thing that we have to understand is balancing an account. At the end of each year, each month or year, or at the end of any particular day, it may become necessary to ascertain the balance in any account. For example, if the page is changing, or if we are having a separate page for a particular day in any account, or let's say at the end of the month, we want to calculate the balance in any account, or at the end of the year, we may need to ascertain the balance, to find out the balance. This would not be a very too difficult thing to do, because if a person has bought goods worth 1,000 rupees and he has paid only 850 rupees, he owes 150 rupees to his supplier, and therefore in the supplier account there will be 150 rupees balance. So to ascertain the balance in any account, what is to be done is that the total of both the sides, debit side and the credit side, are taken, and the difference of the total is then taken. First we total the two sides, debit side and the credit side, and then we take the difference of the two sides, of the two totals, and that difference is the balance of that account. Now, if the credit side is bigger than the debit side, then it is called the credit balance, and if the debit side total is more than the total of the credit side, then it is called the debit balance. So it's simple to understand that whenever the credit side total is more, it's called the credit balance, and whenever the debit side total is more, it is called the debit balance. But if the credit side total is more, then it is written on the debit side to equalize both the sides. The credit balance is written on the debit side as 2 balance carried down, because by making an entry on the debit side, we have to start with 2. Balance carried down, entry is being made on the debit side. CD means carried down. So we put the credit balance on the debit side as 2 balance carried down, and then the two sides will become equal to each other. So the totals are written on the two sides opposite one another. Similarly, the credit balance, we have seen that credit balance is written on the debit side. So the debit balance will be written on the credit side. Here the word credit balance is mentioned, but wrongly. We have to read it debit. Debit balance is written on the credit side, and we start that with buy, because we are writing an entry on the credit side, and every entry on the credit side has to start with buy. So we write balance, buy balance brought down. So whenever we make the entry on the debit side, we write to balance carried down, and whenever we make the entry on the other side, let me just clarify once again that we have to read this. What is written here is that when we take the balance carried down to the next year or to the next page, then we write it on the credit side, because we are taking it on the next page. So therefore, at that time, we'll be writing it on the credit side. So we can say that credit balance, which was written on the debit side, is now being taken on the next page or to the subsequent period or the new period, and it is being brought forward or brought down on the credit side of the next page. So to clarify once again, the credit balance is first written on the debit side as to balance carried down, and thereafter on the next page it is a balance brought down, and it is written on the credit side while taking it to the next page. So the credit balance is written on the credit side as buy balance brought down while bringing it down to the next page, because that is the opening balance for the new period. So the earlier period, let's say, is finished, and we take the total of both the sides, and we find out the balance, and we find that the balance is the credit balance, and that credit balance we write on the debit side as to balance carried down, and then we go on the next page or the next new period, and in the new period we start with the writing the same credit balance on the credit side as balance brought down, which is the opening balance for the new period. Similarly, if there is a debit balance in any account, that is, if the debit side is more than the credit side, the debit balance will be written on the credit side of that account as buy balance carried down. Because we are writing the entry on the credit side, so we write buy, we start with buy. Any entry made on the credit side will start with buy, and buy balance carried down is the debit balance being written on the credit side of the account, and then the totals will become equal on both the sides. And if this debit balance is carried to the next page, it will be written on the debit side of the next page as to balance brought down. So whenever, and that will be the opening balance of the new period. So whenever a balance is being taken to the new period, if it is a credit balance, it will be written on the credit side, and if it is a debit balance, it will be written on the debit side while starting the opening balance of the new period. Whereas while closing the balance of the old period, a debit balance will be written on the credit side, and the credit balance of the period will be taken, of the old period will be written on the debit side. Now, it should be noted that the nominal accounts are not balanced. When we are talking about balancing, as we are doing here, the nominal accounts are not balanced. Not balanced means the two sides are not made equal to each other. Because as you have seen, nominal account, the word nominal means by name. So when I say it is a nominal account, it is being named as an account. It is not actually functioning as an account. It is an account by name. It is named an account. We say, okay, this is an account. So that is why the word nominal, as opposed to real. Real means a real account which actually functions as an account. So all real accounts are balanced. Here, the nominal accounts don't need to be balanced. Even the personal accounts are all balanced. The nominal accounts are not balanced. The balance which is left out in the end of that account is just transferred to the profit and loss account in case of nominal accounts. It is only the personal and the real accounts that will ultimately show the balances, or rather the balance will be entered there and the balancing will be done in the personal and real accounts, but in the nominal account the balancing is not done. So in the illustrations which will follow, we will notice that the capital account, the purchases account, the sales account, the discount account, the rent and the salary account, being the nominal accounts, they don't need to be balanced. So the capital account will have to be adjusted for profit or loss, because when we find out the profit in the profit and loss account, that profit or the loss will go into the capital account, and that is why the capital account will wait for that entry to come in. And so you can say till the time the profit is determined or loss is determined, the capital account will be waiting for the entry from the profit and loss account to be made in the capital account, and so the capital account also doesn't need to be balanced. Now, although the capital account is a personal account of the proprietor, still we are saying that it is not being balanced. And the reason we are giving why it is not being balanced, because it will wait for the profit and loss account profit to come in and entered into that account. So it must be remembered that capital account is also not balanced. Now let us say we start with the illustration. We are asked to prepare a stationery account of a firm, and we are also asked to duly balance it off from the details which are mentioned here. So first thing what we are going to do is that normally whenever some details of transactions are there, as are there in this particular illustration also, normally first thing that we must is that for the case of any transaction or any event, in order to make an account, we must first make a journal entry, and after having made the journal entry, we can go on to make the ledger entry. Of course, this is a very simple example, so what is being shown here is directly an account is being prepared from the transactions. So let us say that on January 1, the inventory of the stationery was 480. So if the inventory of the stationery on January 1 was 480, what we are talking about here is that it is the opening balance of the stationery account at the beginning of the time period starting from January 1, 2015. And we are supposed to make the stationery account for the year ended 31/12/2015. So that means the year is ending on 31/12. Year will start on January 1, 2015. So on January 1, there is a inventory of the stationery. So what the inventory of the stationery in the stationery account will be entered as if it is the opening balance. And opening balance is entered, and opening balance is entered on the debit side as to balance brought down, as you can see here. Because it is an opening balance and it is a debit entry, it is a debit balance, and debit balance is entered. Whenever a debit balance is entered as the opening balance, it is entered on the debit side. So the debit balance is entered here on the debit side by making an entry called to balance brought down. In the previous year, that account must have been closed by this entry by making the entry of the debit balance on the credit side. And at that time, when the entry would have been made on the credit side of the debit balance in the previous year, so that entry would have been by balance carried down. And from by balance carried down debit balance, it is being brought here as the opening balance of this year, and therefore the debit balance is being entered as on the debit side as the opening balance, and therefore since it is entered on the debit side, the starting word is to, and then the word balance brought down for the opening balance. So balance brought down is 480 rupees. Thereafter, the stationery is purchased by check, 800 rupees on April 5. So we make an entry for April 5, and stationery has been purchased, and therefore it is an expenditure. So stationery account is basically an expenditure account, and so when we buy a stationery, we will make entry on the debit side of the expenditure account. What we are doing is stationery account debit. So if the journal entry was supposed to be made here for this transaction of 5th April, the journal entry would say stationery account debit 800. So we are debiting stationery account. While debiting stationery account, what we mean to say is that we are writing this entry on the debit side of the stationery account. So we are debiting the stationery account by writing the entry on the debit side of the stationery account, and in the description we are saying bank account, which means that we are giving description of the credit side of the credit account being credited here, because the journal entry would be stationery account debit 800 and bank account credit 800. So we had looked at the third rule where we had said that while posting in the ledger, when we debit any account, we in the description we write the details of the account which is credited. I'll just show you the rule once again. The concerned account debited in the journal should also be debited in the ledger, but reference should be of the credit account. So the reference should be of the respective credit account. That is what is being done here. The reference is of the account which is credited, which is bank account, while making a debit entry in the stationery account. Similarly, we go on to the next transaction, and there we have purchase of stationery on credit from 5-star Stationery Mart. So stationery is again being purchased here, and here it is the difference is that here the purchase of the stationery is being made on credit and not by making the cash payment or making the check payment. So here again the stationery account is being debited by 1,280 rupees, and in the reference we are writing the account which is being credited. So 5-star Stationery Mart account is being credited for 1,280, and stationery account is being debited here. So these are all the entry, and finally we are left with the inventory of the stationery on December 31. And on December 31, we are having an inventory of the stationery. So here it is important to understand that on December 31, when we are making the inventory of the stationery, that does not find any place out here in the stationery account, because we started with a stationery inventory of 480, then we purchased some stationery, and maybe we use some stationery for our work, and after using the stationery for our work, we are left with stationery of 240 rupees. But in the stationery account is not used to calculate the inventory of that stationery. The stationery account is used to calculate the expenditure. So what we do is that we calculate the balance, we total up the two sides and we find the balance. So we totaled up the debit side and found that the balance total was 2,560 rupees. So this was our debit balance here, and therefore when we saw on the credit side there was no entry, and therefore that side total was 0. So the difference of both sides was 2,560 rupees. So what we did was that on 31/12/2015 we made a debit balance entry on the credit side of the stationery account by writing by balance carried down 2,560, and this will go to the next year on the debit side as to balance brought down 2,560. That is how we are preparing a stationery account out here, and the balance of the stationery account, or the balance carried down of the stationery account, is showing us that at the end of the year, this is the debit balance of the stationery account. So we go to illustration 2 now. In the illustration 2, we are asked to prepare ledger accounts on the basis of the transactions which are in the books of a trader. So on January 1, some debit balances have been given. For January 1, some debit balances are given out here. For example, cash in hand of 8,000 rupees, cash in the bank 25,000, goods inventory is given 20,000, building value is given, trade receivables. Among the trade receivables, there are Vijay 2,000 and Madhu 2,000. So these are all the debit balances, and then we are also given some credit balances, which are the trade payables of 105,000, and there is a credit balance of in the capital account also 55,000 rupees. So having given us the trade balances, the debit and the credit balances on January 1, 2015, then we are told that some transactions were done throughout the year. In the month of January, some transactions were done from January 1 to January 18. So all these transactions are mentioned there. And after doing the transactions, we are told at the end of the month we have to calculate we have to prepare the ledger accounts for the end of the month. So let us see how we prepare the ledger accounts at the end of the month. Now let me point out to you that here in the previous example, on December 31, there was an inventory of stationery of 240 rupees, and you might be wondering why it is not finding a place in the stationery account here of the 240 rupees. Basically, stationery is the type of an item which is generally taken as a revenue item, and even if this 240 rupees stationery is not used up, and it is finding a place in the inventory, normally we just take it as if the entire stationery that we had purchased has been utilized for the purpose of the business, with being a revenue item. And so every year, whatever stationery was there, we take it that stationery has been already used up in the business and debited to the profit and loss account. We don't carry it in our stock inventory in the balance sheet. So that is why this entry is not finding a place. The closing entry of the stationery is not finding a place in this account, because the stationery account balance would be debited to the profit and loss account, being an expenditure account. And this entire amount of stationery that was there in the beginning of the year, and whatever has been used up during the year, that is taken as the expenditure of that particular year. Now here in the illustration 2, we have to look at how the entries are being made in the ledger. So we have to first of all see that which are the accounts that are going to be affected. So let's say first of all there is a cash in hand. So let us look at this cash in hand account more closely and see what will be the entries that will be made in the cash in hand account. As we can see, at the beginning of the year there is a debit balance of 8,000 rupees in the cash in hand account. So we go to the cash account or cash in hand account, and we see that there is a debit balance entry, an opening entry of the debit balance in the cash account as on January 1, 2015, and we can see this entry, opening balance entry, to balance brought down 8,000 rupees. Now whenever cash comes in or cash goes out, the entries would be made in the cash account accordingly. So let us say that, let us look at the next entry that is being made. So we can say here that first of all on January 1 some goods are purchased for 5,000 rupees, now which is payable at a later date. For cash less 20% trade discount and 5% cash discount. So what is being said here is that goods worth 5,000 rupees have been purchased here. There is a 20% trade discount and 5% cash discount on those goods. So let us see how the calculation of this amount is being made here. So 20% is the trade discount and 5% is the cash discount. So in the calculation, if we look at the calculation of this amount, if it is shown here, but otherwise what we can do is straight away we can just calculate it. So let's say on 5,000 rupees there is a, since we are making a cash purchase, because if we had made a 5,000 rupees purchase payable at later date, then we would have to pay 5,000 rupees on a later date, but we are purchasing it for cash. So when we purchase it for cash, there is a 20% discount. So 20% of 5,000 is 1,000, and Thereby, we are left with 4,000 rupees. But on this 4,000 rupees, there is a 5% cash discount. So 5% of 4,000 would come to 200. So first we make a 20% discount on 5,000, which brings the value to 4,000, and then we reduce 5% cash discount on the remaining amount, that is on the 4,000. So we reduce 200 more. So in our total, about 1,200 is reduced here. So 5,000 minus 1,200 gives us a value of 3,800. That is why, as you can see here in the cash account is credited by 3,800 rupees, because 3,800 rupees have been paid out of the cash for making the purchases of the goods. The goods were actually worth 5,000 rupees if they had been purchased on credit, but since cash has been immediately paid, the discount of 1,200 is being given. Here, point to be noted here is that first we make a trade discount reduction, and then on the remaining amount we make a 5% cash discount. We don't just total up 20 plus 5 and say 25%. It is not 25%. It is 20% on 5,000, and then 5% on the remaining amount, which is 4,000. So total is coming to 1,200 discount, and 1,200 reduced from 5,000 gives us a figure of 3,800. Now, obviously, make an entry like this on the credit side. We are crediting the cash account by 3,800, and we are also indicating that corresponding debit entry will go into the purchase account. So if we look at the purchase account, while making entry, both the entries can be made simultaneously so that both accounts get prepared simultaneously. So let's say we look at the purchase account, we'll find that on January 1 in the purchase account, as you can see here, on January 1 there is a entry of 3,800 rupees, and the purchase account is debited, and it is also indicated here that the cash account is credited, as we have already credited the cash account. So reference is always made of when we make an entry on the debit side, the reference is made of the account which is credited. Whenever we make an entry on the credit side of any account, the reference is made of the account which is corresponding account which is debited. Now let's look at the second transaction. In the second transaction, this person receives 1,980 rupees from Vijay, and he has allowed him 20 rupees as a discount while receiving this money from Vijay. Now, therefore, on January 4, we are receiving this money, which means that it will go into the cash account. The account being affected here, the cash account. Vijay's account will also be affected here. Let us see how this entry is being made here. So in the cash account, we are writing 1,980 after reducing the whatever discount was there. We are debiting the cash account by 1,980 because we have received 1,980. So when we debit the cash account by 1,980, what account we credit? Which account are we going to credit? So we are going to credit Vijay's account. So the corresponding entry will go into Vijay's account here. 1,980 is debit entry in cash account. Corresponding entry will go into the Vijay's account. If we look at Vijay's account, here you can see Vijay's account. So when we look at Vijay's account, what is being seen here is that we are writing the cash entry, corresponding cash entry here, 1,980. Okay. And in the Vijay's account, there was a balance brought down of 2000 rupees. So how we are coming to that? Let's see. Here, Vijay's account 2000 rupees. So Vijay in the Vijay's account there was a debit balance, which means that Vijay was supposed to pay us 2000 rupees, but we have allowed 20 rupees discount to Vijay. So for making an entry for discount to Vijay, we'll be making entry in Vijay's account, because to indicate the discount, we have a initial debit balance. So with that debit entry, let us look at the Vijay's account. So the initial debit entry would be there of the balance brought down of 2000 rupees. Okay, out of this 2000 rupees, we make a discount entry. So when we make a discount entry, we credit Vijay's account by the 20 rupees discount, and we debit the discount account by 20 rupees. So allowing discount, what we are doing is we are crediting Vijay's account by 20 rupees and debiting discount account by 20 rupees. And this is a cash account entry where Vijay's account is credited with 1980 because he has paid us cash of 1980 rupees, and we have debited our cash account for 1980 rupees, because this is a double entry book keeping system. So for every transaction we are making two entries for. So whenever there's a transaction of discount, we made a double entry, and for the transaction of cash also, cash receipt also, we have made a double entry. So although you can see here, we have received 1980 from Vijay and allowed him 20 as a discount, these will be seen as two transactions here. One transaction is that receiving money from Vijay, and the other transaction is giving Vijay a discount. So this particular narration here on January 4, it is being seen as two transactions and not one transaction. And that is why for each transaction, a double entry is being made. So when we receive 1980 from Vijay, we credit Vijay's account by 1980 and we debit cash. And for giving discount to Vijay, we credit Vijay's account by 20 rupees and we debit discount account by 20 rupees. Now let's say what is the next transaction that is being made here. We purchased plant from Mukesh for 5000 rupees. We are buying plant from Mukesh for 5000 and we paid 100 rupees as cartage for bringing the plant to the factory, and then we paid another 200 rupees as installation charges. Now what is being done here is that a plant is being purchased. So whenever a plant is purchased, it will go into the plant account, and whatever cartage and installation charges are also there, that will also add up to the cost of the plant. Now let us see what is the opening balance in the plant account, or is there any opening balance in the plant account. So we can see that there is no opening balance in the plant account. So therefore, what we'll do here is that since we are buying the plant, and we are paying, we are purchasing the plant from Mukesh for 500 rupees, and we are paying 100 rupees as cartage, and we are paying 200 rupees as installation charges. So 100 plus 200 is 300 rupees. So the payment that we have made is 300 rupees, and therefore we make entry in the cash account because the payment which has been made here is only 300 rupees. So we credit cash by 300 and this corresponding entry will go to the debit of the plant account, and therefore we debit plant by 300 rupees in respect of this 300 rupees which we have paid here. Now if we look at the plant account, in the plant account we find that there is an entry of 5,000 rupees here. So why this entry of 5,000 rupees is here? Because we have not paid anything to Mukesh. We have just bought a plant, we have just paid cartage and installation. We have not made any payment, so we are supposed to make this 5,000 rupees payment against the plant. So we have debited the plant account for 5,000 rupees and we have credited Mukesh. Why we have credited Mukesh? Because we have to pay this 5,000 rupees to Mukesh. So reference will always show the corresponding credit entry for the debit of any account. And similarly, when we credit the account, the corresponding reference will show the debit, the account which is being debited in that case. So here, while buying the plant, we have not made any payment except the installation and cartage. So when we make the payment, we enter that into the cash account, or when we receive any payment, we enter that in the cash account. But when we purchase something, a plant, let's say, and a plant doesn't mean paudha. Plant means the plant and machinery type of a plant. So plant has been purchased from Mukesh, and for that the credit entry has been made in Mukesh's account. So this 5,000 rupees will have to be paid to Mukesh. So in the future. So what is the journal entry here? The journal entry would be the plant account debit 5,000 and Mukesh to Mukesh, or Mukesh credited 5,000. Now let's say we move on to goods sold to Rahim on credit 600 rupees. Now when we sell goods to Rahim, we have to decide which account are going to be affected by this. Obviously, the sale account would be affected and Rahim's account would be affected. So let us see. Here we have the sale account, and on January 12 here we are seeing that a sale is being made to Rahim for 600 rupees and the corresponding entry will go. So sale account is credited for 600 and Rahim is being debited here for 600, and therefore the reference entry is made in the name of Rahim. So the Rahim account is going to be debited for this credit, for corresponding credit entry. This 600 rupees sale being made to Rahim. Now, on January 15, Rahim became insolvent and could pay only 50 paise in a rupee. Now, this guy Rahim, we had sold goods to him 600 rupees. Now, let's see, was there anything in Rahim's account? Was there any balance in Rahim's account in the beginning? So we go here and see among debit balances, there is no balance here, and there is no balance in out here also. So no credit or no debit balance in Rahim's account to start with. So basically that the sale is made here of 600 rupees, but we find that Rahim became insolvent and therefore he could pay only 50 paise in a rupee, which means he could pay only 50%. That means that remaining part he could not pay. So therefore we go into the Rahim account and we find here that 300 rupees he could not pay. So we have allowed that as a bad debt. So therefore initially we got 300 rupees. We made a sale of 600 rupees. So when we made a sale of 600 rupees, we debited Rahim's account by 600 rupees. Thereafter, he paid us 300 rupees, 50 paise to a rupee. And when he paid us 300 rupees, we debited the cash account and we credited Rahim's account by 300 rupees. And then he told us that he won't be able to pay us the remaining 300 rupees. And when he said that he won't be able to pay us the remaining 300 rupees, what we did was that we credited Rahim's account. Okay, don't pay, we are crediting your account even without payment. And we debit the bad debt account. And this is our bad debt. So bad debt account debit 300, Rahim account credited 300 rupees. As you can see, the bad debt account is getting an entry of 300 rupees here, bad debt account debit, and corresponding reference is made to Rahim's account, and the balance of the bad debt is 300 rupees, and that is mentioned as balance carried down here. And finally, in the next month, it will be a balance brought down 300 rupees. So then we go on to the last entry, which is sold goods to Ram for cash 1000 rupees. So when cash is being paid for these goods which are being sold to Ram, obviously there will be a debit entry in the cash account. So here we can see this debit entry in cash account 1000 rupees. And corresponding reference is to the sales account. So that means sales account is going to be credited for this 1000 rupees. So these are all the transactions which have been entered here. So after all the transactions are entered, we take the balances of both sides of the account, and we, for example, in this cash account, we have found a total of 11,280 rupees. And on the other side, we find a total of on the other side, we find a total of 4,100 rupees. So as you can see here, 3,800 plus 300, which is 4,100. On this side is 11,280. So the balance of the two sides is 7180, which we are writing here as balance carried down 7180. And since debit side is more than the credit side, this balance will be called the debit balance. A debit balance which is written on the credit side by making the entry in this form like balance carried, and this same entry brought forward as the balance brought down in the beginning of the next month. So what happens to other accounts? Let's say bank account. In the bank account, no entry is being made, only the balance which was there in the beginning, it is the same balance is carried to the next year. As you can see, on January 1, a balance was brought down of 25,000 rupees, and the same balance is then carried down on January 31st, and then the same balance is brought down to February 1. So balance is mentioned, it should be mentioned as a balance brought down, just like here in this case. So in the bank account, it should be like two balance brought down 25,000, and then on January 31, balance carried down 25,000, and then of course in the beginning of the next month, two balance brought down 25,000. Similarly for inventory account also, all the other accounts which are mentioned here, which have not been affected by any transaction, they will be just entered as opening balance and a closing balance, and that's all. And accordingly, there will be those accounts will be closed. Like building account is closed here. Nothing. We are not buying any building, not selling any building. As far as inventory is concerned, no change in the inventory also. And whatever other entries we have already made, For example, Madhu's account, no changes there. Same thing, balance brought down 2000, balance carried down 2000, and capital account also no change. Unless we calculate the profit and all, it won't go into the capital account. Once we calculate profit, then it goes into the capital account. Purchase entry we have already made. Here, discount entry has been made. Plant entry has also been made. Mukesh, in Mukesh's account there is this plant entry, and then sale account entry is also made. Rahim, in case of Rahim also, there is a bad debt and cash account corresponding entry, and then in bad debt account also there is an entry of 300 rupees, where 300 rupees could not be taken from Rahim. So we are doing ledger, and we are at illustration 3, and we'll be continuing with illustration 3 in the evening session of the same topic called ledger. So please try to revise till here, so that when we do the remaining session in the evening, you will be able to get the entire hang of this particular topic. So with those words, today's session, morning session, comes to a close, and we invite you to our evening session, being second part of the session on ledger. Please bring your questions also if you have any. In the evening part, please take this document from icai.org and revise it. Thank you very much for having joined us for this session.